Are you curious about how to maximize savings, reduce income taxes, and increase your retirement income? Then understanding the various investment accounts is key. In this video, we'll delve into taxable brokerage accounts, tax-deferred retirement accounts, and tax-free Roth accounts. Specifically, we'll learn how they are funded, how they are taxed, how they are passed on to your beneficiaries, and how to integrate them into your retirement plan for optimal results. Hi, my name is JP Geisbauer, founder of Centerpoint Financial Management. I'm a certified financial planner professional, a certified public accountant, and this channel is dedicated to helping diligent savers maximize their lives and minimize taxes as they make the transition into retirement. Before we dive into the three accounts, let's discuss how investments create income. There are essentially two features. The first is the income that you earn while you're holding the investment. This can be in the form of typically dividends or interests. Secondly, there is the capital gain or loss when you decide to sell your investment. Let's take a look at a typical investment cycle. Say, for example, you purchased shares of XYZ Corporation for $100 a few years back. Since you've owned that stock, XYZ Corporation has been paying you $4 a year as a dividend. At this time, you no longer wish to hold the share of XYZ Corporation, so you decide to sell it for its price of $110. Once sold, you realize the cash and now have the ability to start that investment cycle all over again with a new investment. So what is the tax treatment of this particular investment cycle? You had $100 and you purchased one share of stock. That $100 is now considered its cost basis. During the time that you own the shares, you were paid $4 per year as a dividend. As the stock appreciated to $110, you had a $10 unrealized gain within the account. And when you ultimately sold the share of XYZ Corporation, you had $110 in cash and a $10 capital gain. And now that you have realized $110 in cash, you can go reinvest that in another company. So that's essentially the life cycle of an investment. Now, this is admittedly oversimplified for the purpose of this video, but this is generally how the investment income life cycle works. So now that we got our arms around this, let's look at how this activity is taxed within the three different investment accounts. The first type of account we're going to discuss today is a brokerage account. This account can go by a couple of names: brokerage account, taxable account, investments account, or non-qualified account. Brokerage accounts are typically funded with after-tax dollars, and there's no restrictions in how much you can contribute to a brokerage account. The investment income in a brokerage account is taxed annually. Any interest or dividends earned within that year are considered taxable income. So let's go back to our example of XYZ Corporation. Every year, you would have a taxable dividend income of $4. Additionally, in the year that you sold the share of XYZ Corporation, you would have to recognize the $10 gain. Depending on the holding period, the capital gain can be taxed at short or long-term capital gain rates. So going back to our example of XYZ Corporation, in the year that the stock appreciated up to $10, there was no gain or loss at that point in time, as it was unrealized. However, in the year that the stock was sold, there would be a $10 gain realized, and because ours was held over multiple years, it would be considered a long-term capital gain. This gain would then be reported on your individual income tax return. Now, the taxation of these accounts can get pretty complicated depending on the type of investments that you have within that account. But the takeaway here is that you're taxed on the activity within the account every year. And as we compare this to the other accounts, you'll begin to see the difference. Beneficiaries. A significant benefit from this account is from an inheritance perspective. When your beneficiaries inherit this account, they will get something called a step-up in basis. What this basically means is if that they sold the assets on the day that you died, they would recognize no gain or loss on that transaction. This particular aspect of a brokerage account can provide an excellent financial planning opportunity. So to clarify this example, let's go back to XYZ Corporation. If you were to pass while the shares were $110, your beneficiaries would inherit that stock, and their cost basis would be $110. Recall that you purchased the shares at $100. But because of the step up in basis, your beneficiary's cost basis in that stock is now $110. Thus, that $10 gain essentially disappears forever. This is quite a deal for your beneficiaries and taxpayers in general. The second type of account I'm going to talk about today are pre-tax or traditional retirement accounts. This type of account can come in many different configurations, such as an IRA, a 401k plan, SEPs, Simples, 403Bs. All of these have the pre-tax feature funding. These type accounts are typically funded with pre-tax dollars. This simply means that if done correctly, you received a tax deduction or a tax benefit in the year in which you funded these accounts. However, there are restrictions to how much you can contribute to any one account in any given tax year. These restrictions typically involve wage income, earned income, and the type of retirement plan that you have. So unlike the brokerage account, you can't just contribute unlimited amounts of money to these types of retirement plans. These funding limits can be incredibly complex, so make sure you discuss them with your financial advisor or tax professional before contributing to any of these type of plans. So let's take an example of perhaps the most common type of retirement plan, the 401k plan. If you fund your 401k plan with pre-tax dollars, your taxable salary will be reduced by the amount of the contribution. For example, if you earned $100,000 and you contributed $20,000 to the 401k plan, the taxable salary for federal and state income tax purposes will be reduced to $80,000. But again, each retirement plan has its own restrictions, so make sure you double check before contributing. How are these accounts taxed? These accounts are considered tax deferred, meaning any of the activity that occurs in them are not taxed. As such, the power of compounding within these accounts is significant over time. So let's go back to our example of XYZ Corporation. The dividends in the years in which they were paid are not considered taxable income to the account holder. Neither is the $10 capital gain. Rather than being taxed on the income in the account as it occurs, these accounts are taxed as you take distributions from them. And these distributions are taxed at ordinary income tax rates, which are usually the highest tax rates to a taxpayer. So you get the tax benefit when you fund the account. It's able to grow tax-free by the activity within the account, but you are forced to pay ordinary income tax rates when you take distributions from the account. Also, at a certain age, the account holder is forced to take distributions from the account called required minimum distributions, or RMDs. Again, these are tax deferred accounts, meaning that you will have to pay the tax at some point in time. And the required minimum distributions are a way to force you to take distributions and pay the related income taxes. I did another video on strategies for reducing required minimum distributions. You will find a link to that video in the description below or as a pop-up at the end of this video. Beneficiaries. When your beneficiaries inherit these type of accounts, their distributions will also be considered ordinary income. Unlike the brokerage account, there is no step up in basis in these particular accounts. Now, there are different rules regarding how long your beneficiaries must take to zero out these accounts once they've inherited it. So make sure you check on those rules depending upon who your beneficiary is. Number 3, Roths. Like the pre-tax retirement accounts previously mentioned, Roths are also a type of retirement account. You've likely heard of them called Roth IRAs, Roth 401ks, or the recently created Roth SEPs. Funding. Like the pre-tax retirement accounts, funding a Roth is restricted based upon earned income and the type of Roth retirement account that you have. And just as I mentioned in the pre-retirement accounts, you'll want to do some research as to the type of account that you have and how much you're able to fund to it in any given year. However, unlike the pre-tax retirement accounts, you do not receive a deduction or tax benefit in the year that you fund a Roth account. Taxes. You do not receive a tax benefit for funding a Roth. Rather, once the funds are in the account, that account is allowed to grow tax-free. This is very similar to the pre-retirement accounts. However, unlike those accounts, even distributions from a Roth are considered tax-free. Now, there are some restrictions around that given your age and the amount of time you've held that account, so make sure you double check with those rules before taking a distribution from a Roth. Beneficiaries. Not only are Roths tax-free to the initial account holder, they're also tax-free to the initial account holder's beneficiaries. So after the beneficiaries have inherited the account, they can take distributions from that account tax-free. Suffice it to say, Roth accounts are amazing, especially if you can get them sufficiently funded. And if you're looking for ways to supersize your Roth account, check out my video on Roth conversions. You will find a link to that video in the description below, or wait to the end of this video where a link will pop up. So let's summarize the benefits of each of these accounts. The brokerage account. There are no limits to funding a brokerage account. The appreciation of the investments isn't taxed until the investment is actually sold. And when it is sold, it's subject to the usually lower capital gains tax rates. Investments in the brokerage account are allowed to pass on to beneficiaries with a step-up in basis, essentially eliminating the gain for the beneficiaries. Unfortunately, you are taxed on the activity within the account as the activity occurs. When it comes to the pre-tax accounts, you get a tax deduction or tax benefit in the year that you contribute to the account. The investment growth and income within the account are allowed to grow tax-free. However, there is a limit to how much you contribute to any one of these plans. You will also be forced to take distributions from these accounts, and these distributions will be taxed at the normally higher ordinary income tax rates. Also, when your beneficiaries inherit these accounts, they'll be forced to take required minimum distributions as well, and they'll be taxed at their ordinary income tax rates. Roths. The Roths are tax-free forever to both you and your beneficiaries. However, it can be a bit tricky to get a substantial amount of funds into a Roth account. So as you can see, there are both pros and cons to all three of these type of accounts. Try to use these accounts in such a way that you can maximize the benefits of each. And as you pull back the lens, you'll begin to see that the choices you make not only affect the tax year in which you are currently in, but they'll affect the amount of taxes that you'll pay for the rest of your life. So make sure that your financial plan considers your lifetime and even the lifetime of your beneficiaries, so you can ultimately reduce the amount of income tax you pay over your life and create tax-efficient income in retirement. Well, if you made it this far, thank you for watching. If you enjoyed this content, please hit like or subscribe below. Thanks again for watching, and I'll see you next time.